Please welcome your panelists for Lessons from the Great Recovery, How to Maintain Investment Momentum, moderated by Bloomberg television anchor Scarlet Fu.
Thank you, everyone, and good morning. Thank you so much for joining us as we explore the lessons from the Great Recovery, although some would quibble at how great it's really been, and how to maintain investment momentum. We know economic expansions don't last forever, so what have we learned from this period of growth? And what do we need to be mindful of as we consider the road ahead? Joining us is, from my left here, Steve Tananbaum. He's founding partner and CIO of GoldenTree Asset Management. Emmanuel Roman, CEO of PIMCO, which has $1.7 trillion in assets under management. Jonathan Lavine of Bain Capital, co-managing partner and CIO of Bain Capital Credit. To my right, Bill Ford, CEO of General Atlantic, which is a global growth equities firm. He's invested in and helped build companies from First Republic Bank to Priceline. And Tom Finke, chairman and CEO of Barings, which has $305 billion in assets under management. So let's start and provide some context for everyone here. I want to talk about where we are in your specific market cycle. Manny, why don't you get us started when you look at fixed income equities, the economic cycle?
So I think we are late in the business cycle. It's been an amazing recovery that everyone in this room has benefited from. So we should acknowledge this. We think that rates are drifting slightly higher. There may be a bit more inflation than we all expect, especially over the next 6 months. Oil is high, you have a tight labor market, nothing I'm telling you which is so surprising. We also think that equities are fully valued, to say the least. And so you have an investment opportunity which looks like the end of a bull market, that everything sort of looks expensive, and you need to be quite careful about how you deploy capital, and there is some significant downside.
So late cycle is something we've heard quite a bit. Tom, what's different in where we are now versus where we've been in the past, in previous late cycles, and how do you adjust for it?
I think a couple things. Well, I don't know that we're firmly in a late cycle, maybe mid moving to late. I think it's very hard to navigate this cycle because there's so many growth industries through technology and disruption. It's just not your normal manufacturing or even services cycle. And so I think it makes it hard to say, how late are you? You know, why are we, in what the third longest, going on second longest recovery, is we are living through a very different economic era of disruption and technological innovation. Yeah, I think when you look at underlying markets, you look at the credit markets, we haven't seen defaults rise materially. They're really tied to sectors like retail where there's disruption. So that's why I think, I'd say we're maybe the end of the mid part of the cycle.
And Jonathan, we spoke earlier, you were saying to answer that question is difficult because you can't compare it to what has been in the past. Asking where we are in the cycle ignores the fact that there are different cycles.
Right. At Bain Capital, we manage a variety of assets from private equity, credit, venture, life sciences, social impact, and across 19 offices globally. In our two largest businesses, credit and private equity, the story is quite global. In private equity, we clearly have been selling more than we've been buying. We sold 2 or 3 times more last year than we bought. But we clearly have seen places to buy companies, but the stories are stories where value is found where you do something to the company. You just don't find something undervalued. You have to take actions in combining 2 companies and helping work through changes in strategy, growth stories, streamlining, and things like that. You have to actually work the company. And on the credit side, the story this time, I think, is very different than in cycles past, where the question used to be, where are we in the credit cycle, meant where are U.S. high-yield spreads? Where are bank loan spreads? And I think because coming out of 2008, the recoveries were so different in the U.S., Europe, and Asia, and the government actions were different. When I think of the variety of what we're looking at today, I think rescue financings in Italy and NPLs in Spain and private loans in Australia and regular way bank loans in the United States and things we were working on in Asia actually might not all correlate the same way they have in the past. And I think that that's going to be interesting to watch, particularly with the rate action in the United States, which clearly is going to be the headline story over the next 6 to 9 months.
All right, let's make some headlines with some charts. Steve Tananbaum, you came complete with visual aids here to help us determine where we are in the cycle.
Yeah, so since 1850, we're currently in the second longest expansion, over 9 years.
This is slide 2, by the way.
On slide 2.
And we'll pull that up.
So, as you can see, the magnitude isn't that great, but the length is pretty long, and it looks most likely as if we're going to break a record. So the duration's good. In terms of a crystal ball, whether we're 1 year left or 5 years left, don't have a crystal ball. But if you look at other countries that have had this type of expansion, and for instance, Australia, where there's been in the last 10 years, so Australia's had an expansion 26 years, but the last 10 years, there's been 4 drawdowns of 20%. So the market has predicted a recession 4 times, which hasn't occurred. So if you look at the pricing of where we are, turning it to the U.S. market, and I agree with Jonathan that not all the markets are correlated. In fact, they aren't, and something like Spain NPLs would be driven by the magnitude of your duration of that investment, opposed to pretty much how long the duration of collecting, because it's an NPL, than really what the how the economy does short term. But turning to the U.S., you'll see that we're priced as if we're going to be 5 years mid-cycle in an expansion. So there's not much room for error. If you look at spreads, they're at 10-year tights. If you look at through a bunch of criteria, if you look at dispersion, which I think slide 4, you have a
slide 4. There we go.
So this measures the percentage of the market that's above and below 95, and you'll see that we're much closer to this mid-cycle environment than we are to a stressed environment. So what it comes down to, in terms of at least in the U.S., you're not given. It's assuming as if you have several years left in the expansion. So when I'm looking at how to position for the market, you're going to get better entry points like Australia.
All right, and Bill, I want to come to you as well. In growth equities, where are we? And it's an interesting question because we've seen signs that the IPO market is coming back.
Exactly. I would say that I feel like despite the fact that equity markets are elevated and near all-time highs in most parts of the world, they're actually in a very attractive part of the growth equity cycle. And the reason I say that is really twofold. One is entrepreneurship and innovation is globalizing. Mm-hmm. We're seeing just as many opportunities in Europe, India, China as we are in the U.S. in terms of real growth companies. And the second is, I think, as Tom referred to it, we're really in a long-term transition to a digital economy. And technology is impacting virtually every industry at different paces and really in every part of the world. And that's creating, I think, a long cycle opportunity that's been quite attractive. I think the IPO market is actually on the precipice of coming back. It may not be maybe too strong to say we're having an IPO renaissance is upon us, but we're moving into what I think a very attractive period. One, there's a number of really exciting companies that will come out in the next couple of years. Airbnb, Uber, another company in our portfolio, Adyen, a payment processor, a number in China, Meituan, Toutiao, all lining up for 2019, 2020 IPOs. I think that'll be quite exciting. And second, if you look back at the IPO market historically, there's 2 factors that really create the sweet spot. One is positive equity returns for investors, and we've had that over the last several years. And the second is volatility. And the way I describe it, not too cold, not too hot volatility.
Right.
Kind of in the mid-teens, and we're right at 15 right now at the VIX. And volatility helps the IPO investor and actually attracts interest. So I think those conditions are really setting up for a pretty attractive IPO cycle.
And I'm glad you bring up volatility. We have the chart that shows volatility to increase. You mentioned how it helps the IPO cycle. Tom, with volatility making a bit of a comeback, we're seeing signs of it. I wonder about the timing with most markets at a cyclical peak. Is there a cause and effect here going on? I mean, is volatility increasing because markets are peaking or have peaked, or is the rising of prices causing an increase in volatility?
I think a couple things. I'm sure that's part to do with it. I think we experienced a period of time before we had the spike recently in volatility where it was probably unnaturally low. I agree with Bill. You need a level of volatility in markets as part of the normal cycle. And what we're seeing now certainly is a return to maybe a more normalized level of volatility. I think from the equity markets, how that plays in other markets. So if you take an example of some of the recent sell-off in the equity markets, we saw markets like high yield markets react, but not, they didn't widen out as much as they did when you had the taper tantrum and back in the Euro crisis. So I think it's just not as, I don't think we're as far along in the vol cycle, but it's probably better that we're in that mid-teens.
Well, Manny, how are you adjusting to an increase in volatility? If not the comeback, at least a pickup in volatility. What changes are you making?
I think one of the things about volatility is there's two things. One, the fact that it does reflect shift in GDP. And so when you look at a long-term graph, you actually see that equity volatility is linked to surprise in GDP, and clearly the surprise has gone down. Now, the other thing which is obvious is that higher volatility means higher risk premium. And so for everyone who manages active portfolio, you have more risk than you think you do. That's the first order constraint. And then the second one is that the correlation, especially between equity and fixed income, is shifting, and that you need to think about your risk and think about what can go wrong. And I think that what a lot of people have to right now think about is how the combined portfolio looks like, and then shift various factors, volatility being one of them, and see how the portfolio can be stress tested in various environments. And there's many ways to do it, but I think that collectively something that we all ought to do, because the correlation metrics we had since 1985 may not be stable going forward. We had unbelievable market where, and I can say this having started in this business in 1987, we basically saw a straight up equity market going up and a straight down bond market going up and yield going down, and that may not be the case going forward.
I was an '87 grad and fully agree with Manny about, from a risk management perspective, increased volatility, you have to change the way you risk manage and basically adjust your portfolio the more volatile the environment. Another aspect of volatility is, this is less so on the equity side and more so on the credit side, is the complacency. So you look at, if volatility is a difference of opinion, and low volatility, there's a low difference of opinion. High volatility is a greater difference of opinion. You get more rewarded in a high volatile environment. So take last year with Toys R Us. So Toys R Us announces they have a liquidity issue. This is a retailer. Retailers do not announce they have liquidity issues unless it's pretty dire. The bonds fall about 5%, about 5 points the first week or so. Within, call it a few weeks, they're down from 85 to the mid-20s. Pretty significant fall that was pretty much in slow motion. Contrast that with last week, American Tire, largest tire distributor, $500 million EBITDA company, announces that Goodyear and Bridgewater are going to form a partnership to compete against them. They're some of their larger suppliers. This is American Tires. The bonds drop 50 points within 48 hours. So in one market, you're innocent until proven guilty in the case of Toys R Us. In the case of American Tire, you're guilty or you're in effect almost a fault until proven innocent. So it's a really different type of environment.
Jonathan, jump in here. Is volatility a risk to the expansion that we're seeing?
I think that one of the most important things, and it comes out in what Steve says, you have to understand the difference between volatility changes and value changes. And it gets harder when you watch prices move back and forth and you have to explain to your investors in the structure of the market that I think what I own is more attractive because some people in the market are panicking because there is some piece of information. There's also volatility on the equity side that's been increased due to computers. But one of the things I show people is two charts, a tech company earnings over 3 years and a retailer's earnings over 3 years. And when you look at the stock price, the retailer's earnings went down, and the stock price goes like this, but over 3 years, it actually goes down. The tech company's earnings go up over 3 years, but it goes like this to get there. And there's lots of times where if you didn't have either the right kind of locked up capital or the ability to enunciate it to your investors, you might have been stopped out of the investment and not been able to hold on. And I think that volatility will create opportunities to buy, but will make it much harder to hold. And I think we can't lose sight of the fact that as investors, we are buying things now because we think they're more valuable later, and that volatility does not change the value of an investment in the long run, and we need to make sure that we're buying them in a form that we can hold them through volatility. And that means don't buy them on leverage, don't buy long-dated assets in short-dated funds, and make sure that we've articulated to the investors who are invested in those funds what the risks are, and one of those risks are volatility.
That's a great distinction here. So as we look ahead to figuring out how to position for the future, I want to shift now into risks to this recovery and things that keep you up at night. Certainly volatility may add to confusion over how to value things, but Bill, we were talking about how big picture, you look at the US-China relationship and how that's a concern for you, because this is a relationship that you said is not being managed very well right now.
I think that's correct, Scarlett. If you look at China and you think about it, it's going to be the largest economy in the world within the next 10 years. It's a $20 trillion economy by 2020. And I think how we manage the rise of China is critical to global peace and actually global prosperity. And it's something we think about a lot. And I think right now, the way the trade negotiations are being managed is probably, back to the word volatility, creating probably more volatility than necessary. It potentially is going to be the largest market in the world for many of the U.S. Tech companies and actually U.S. industries. So it's something we're watching pretty carefully, and I hope we can keep it on track, because it's you know, again, if it's managed well, I think it's great for the world and great for investors.
It's just not managed well at the moment.
Right now, I mean, there's too much tit for tat, I think, on the trade side, when we just have to recognize that they're going to grow 5, 6, 7% over the years ahead and become a large economy, and one that we can benefit from. And just running on a bit for a minute about it, I think the two most important things we need to focus on is market access, let our companies have access to that market in a much more efficient manner, and to intellectual property protection. And despite a lot of talk about it, there have been real abuses on intellectual property in China. And I think if we could focus the trade negotiations on those two topics, we'll make real progress.
Well, the road to getting there, though, is pretty rocky at the moment. Tom, you've been smiling and nodding all along while Bill was speaking.
Well, certainly when you read the headlines, trade jumps out at you as a risk, but I agree, you're not going to put the China genie back in the bottle. And what we don't see sometimes, though, is what below the political headlines is the interaction of businesses between China and the U.S. I agree, they need to continue to open the markets, and they're coming out of the 19th Congress, they made some statements which lean towards that. But it's a long road. China moves at a slower pace. But for companies, whether it's financial services or technology, there's increasing interdependence between China business and U.S. business. And the reality is that will lead global growth in the next 10 years. So while I agree we should be mindful and worry about the trade and the political, if you will, gamesmanship going on, I think long-term, it's the business interdependence that's going to drive the relationships.
Manny, how do you worry about China-U.S. relations? Does it factor into how you approach things?
A lot, and we spend plenty of time trying to understand what's happening. I mean, I have to say I have a certain amount of sympathy for China, because the reality is they have to deal with an administration who deals with trade policy in a very different way than most of us have seen for the past 30 years. And so they're also learning as they go. I think it is the most likely outcome is you come to some realistic compromise, and people put the issue behind. I think the same thing can be said about NAFTA, where we still don't have an agreement, and NAFTA matters a lot to a lot of us in this room. And so there's a Canadian angle, there's a Mexican angle, and I think that also needs to be resolved. The thing about China in the back of our mind also is to think about how many years can China grow at 6.5%. And we feel pretty comfortable about 2018, but down the road, none of us have ever seen an economy growing at 6.5% at infinite. And so at some point in time, there'll be slower growth in China, and that'll be part of the adjustment process. And that will, of course, impact global growth as we know it.
Jonathan, you've long been active in China. Do the current tensions temper your willingness to do deals in that country, in that region?
It doesn't, but I think that it creates imponderables that are very, very difficult to price. And therefore, I think that there'll be a lot of wait and see. When you think about investing in a region, you're often thinking about local things that are going to impact how you approach a region. And you have the added element now of how our government is going to impact our ability to invest in a particular region. And, I can't say with any, intelligent insight right now what our view is on that other than to wait and see. And I know there's a big delegation going over there on Thursday.
Right.
So we're really hopeful a lot gets accomplished.
Steve?
Sure. China is certainly on our list of worries. It's not the top on our list. And we think that, broadly speaking, that trade will get resolved to not be burdensome to the U.S. economy. In terms of what is the top of our list, it's inflation and rising rates. So if you look at the
Slide 6, everyone.
at the relationship between wage growth, which is the largest component of inflation, and the unemployment rate, that's the Phillips curve. And that's been not a great predictor this cycle. But if you look at the adjusted or the modified Phillips curve and look at participation rate instead of the unemployment rate, it tells a much different story historically and where we are now. We think that we're at a tipping point where inflation is about to accelerate. And if inflation accelerates, that means that rates are going to be higher. And if rates are higher, the risk premium is going to be wider. And we feel as if there's going to be some dislocations, particularly in the lower part of the credit parts like triple Cs, which historically have run up in anticipation, and historically later in the cycle performed quite poorly. So we do think in terms of what we are concerned about, it's really more inflation and rising rates. That's our top. We also kind of right underneath that would be what happens with the elections. You've had the Trump bump from a deregulation of the economy or expected deregulation, and that'll be put on pause if the Democrats take both houses, and certainly will be more complicated if they just take one, and it could potentially even go backwards to re-regulation. So that would be also on my list.
I want to pick up on that idea of inflation and how it hasn't appeared the way people expect. A lot of people pin the blame on technology, of course. So let's segue to technology overall. And Bill, I want to come to you here because this is something you think about a lot, which is the regulatory backlash against big tech companies, the Facebooks, the Alphabets, the Twitters of the world. Regulation is a very slow-moving train, as we know, and it's unlikely, people say, that Congress can or will do anything in the near term. Europe, however, has been taking the lead. What do we give up by letting Europe drive this train?
Well, just going back to what's driving this move by governments to sort of get involved in the tech sector is I think last year they woke up to the fact that Facebook is a global company of 1.7 billion people using its.
It's a country into itself.
With unbelievable scale and reach. And if you look at Google, I mean, more than half of online advertising dollars are now going to one company in Google, and it's completely disrupted the traditional advertising space and the traditional media space. So I think those two things alone, I think, cause government to step up and really begin to ask questions. Europe has always been concerned about the monopoly power of tech companies. We've seen it over the last couple of decades. But I think the issue around data privacy is what's really spurred them to action. And this the new consumer data protection regulations that they put in place are actually quite thoughtful, and I think will be a model for what might happen here. And they really are leading the way. And I think we're a little bit flat-footed here. The government's been saying we're angry at what happened with Facebook. We're angry about how privacy is being handled. But we haven't put forward actually any constructive policies, and we're seeing more of it out of Europe right now.
Is that bad ultimately? Does that stymie our growth?
I don't think so. I think a lot of people in the tech sector would say that the regulation on privacy put forth by Europe is quite thoughtful. And maybe some modifications would work quite well here.
Okay, let's talk now more broadly about technology and the disruption that it creates. And Manny, this is something I know that you think a lot about, which is AI, machine learning, quants. They become a much larger part of how managers run their portfolio. It's changing the asset management industry overall. What's different now, a year later, after we talked about this last year at Milken Conference? I mean, it's happening slowly, but it's happening quickly at the same time.
So we have a very big long-only business, and obviously we need to generate performance and generate what we call alpha, which is the outperformance versus a benchmark. And there's many ways to do this. And we do think that part of the solution, not the only solution, is data and the ability to build analytics and the ability to acquire new way to think about issues. So for example, we have a very big mortgage portfolio. We need to have data about every single loans and real estate transaction in the US. And for that, you need to be able, quote unquote, to find the right data, to clean them, to find the right level of detail on household, and to be able to derive analytics in terms of prepayment and price action that we care about. And the scale of what we need to do at PIMCO is important. We're opening a new office in Austin for this reason. We're hiring 200 people in technology. We're increasing our CapEx. And I think that is one of the things that asset management company and all of us have to do. We're investing more into other ways to look at this. Now, what is machine learning? What is AI? It's a way to take all of this data and derive conditional probability in terms of what may happen. And anything which helps us getting an edge is a good thing. Now, it doesn't substitute itself for a macro process. It doesn't substitute itself for bottom-up credit analysis. It is one more way to look at what we're trying to do. And so we're excited about it, and some of the things we're going to try will be very successful, and some of them may not work, and I think you need to take some risk in terms of R&D, in terms of what we're trying to do.
So you're saying it's a tool more than anything else?
It's absolutely a tool, but a very useful one, and I think a tool that a lot of people are going to use. And actually, we're not that different from many other companies using a lot of data to get better analytics and better way to communicate with customers.
But is it changing the asset management industry for the worse? I mean, Tom, it must impact how you do your job, how you think of value, how you underwrite credit.
Well, I answer, is it changing for the worse? It depends who's asking the question. Is it making it a more economic model for the investors? Is it driving fees down? That's a pressure on the industry itself. But I agree with Manny. I mean, there's a lot on the come. We're fundamental investors. We earn a fee by finding that value, and we find that value either through our analytics, which AI and data will have a big impact, your ability to call more and make those alpha decisions. But it's also, I think, for asset managers, you're shifting to where you're originating more of that alpha. You have to go out and find the deals, put the deals together, not just in private markets, but I think you'll see that in public markets. Go back to the 80s, and a lot of people on Wall Street made money selling government bonds. Well, now we're trading a lot of these markets online, and that trend's not ending, because what we're doing is there's a lot of friction and fees in the process between the issuers or the borrowers or the capital raisers and the ultimate investors. And what technology is allowing you to do is for the companies in the middle, the intermediaries, how are we shrinking that friction, but keeping our business in terms of adding value to investors? So short term, it is very disruptive to the asset management industry. Long term, it should benefit investors and issuers alike.
Jonathan, what about you?
Well, I think there's a couple of components to it. Most of our businesses are fundamental businesses that don't have electronic trading and don't have things like that. So it's going to impact us in two ways. One, the businesses we invest in are going to be impacted by technology. And thinking about how that's going to affect manufacturing companies, service companies, retailers, things like that. On the venture side, the companies that they themselves are investing in.
Yeah.
Internally, as we think about it, how can we ourselves learn more about how we invest and how to make better investments on the basis of 30 years of data about ourselves and about the companies that we've invested in, that we've been aggregating and we've spent a lot of time doing, but also understanding that it doesn't substitute for judgment in a lot of things, particularly in our lending businesses, where we loan to a lot of small businesses that have a story. And I don't think that AI is going to get the story for a long time to come. I'm sure eventually, maybe one day, it'll get those intangibles. Our impact business, obviously, almost all of those have a story around them. So I think there's going to be probably a longer arc of understanding how that comes into play in the private asset area. But I think people who are resistant to it and aren't willing to try and experiment a little bit will be left behind.
So I agree with Tom in terms of AI improving efficiency and data improving efficiency on the expense side. But I might also agree with Manny and John on the tool side that it's going to be, you wouldn't want to compete against somebody who's fluent in data if you're not. So let me give you an example. Puerto Rico, after Maria, there was an issue of migration. How many people left the island? There was about 3.4 million people, and there were reports of 500,000 people or 100,000 people. Pretty wide discrepancy.
Yeah.
And it was by credible sources quoting both. Well, we were able to get the number of people who transferred, who relocated their cell phones. That was about 70 or 80,000. Seemed like 100,000 was a lot better estimate than 500,000. When looking, so that's an example of where data and access to information wouldn't have been available a decade ago, but it's available now. Whether it's looking at information for retailers in terms of credit card data or credit card data at malls. So it's an improvement in terms of being able to do fundamental research.
Right. It's, as we go back to that idea, it's a tool, it's a supplement to what we have already. You had talked about the 80s. I want to go to the idea that there is it's been a long time since we've seen any kind of real downturn. And certainly it's been a long time since we've had a bond bear market. There's a lack of experience among people on Wall Street, some say, and it's easy to forget the lessons that we should have learned from the past. John, you say that in your last annual letter, you showed a picture of the moon landing to remind people of an important lesson. Explain what you're trying to do there.
Yes, it wasn't fake news. I showed the moon landing to remind people that just because you've never seen something before doesn't mean it can't happen. And we're 10 years out of the Great Recession, which means we're 12, 13 years out of the mistakes people were made leading up to it. And if you think about how long it takes from the time you graduate business school to get a position of responsibility at a hedge fund on Wall Street, there's a lot of people who hear us talking about what 05, 06, 07 was like, and look at us the way we look at our parents when they talked about their parents talking about the Depression. And I think it's really, really important to not discard, oh, that couldn't happen again, and not forget that I don't think that the next downturn is going to be caused by subprime mortgages. Everybody will go fight the last battle. I'm pretty sure it's not going to come from that. And we have to keep looking into whatever arcane corner of finance has been sliced and diced in a way that very few people have been paying attention to until it starts creeping into the news. And I think that's really important.
Yeah, one thing, just picking up on Jonathan's comments, I think about looking back to a period of time when we had the tech bust around 2000. And really since then, well, at that moment in time, access to capital became very difficult, particularly on the equity side. It was virtually turned off for growth companies for a period of time. And really since then, markets have been more or less completely open. Even during the Great Recession and the global financial crisis, access to capital kind of continued. And I really wonder if we're prepared and companies are prepared for a period when access to capital was severely limited for some reason. And I like Jonathan just said, I don't know what will cause the downturn or cause that to happen. But again, I think there's a complacency right now that it can't because there's so much money in the world. But we've seen it before.
Right. We've been trained to think that money can be cheap forever.
Exactly.
So, Manny, do you see any evidence of undisciplined behavior as people reach for yield? I mean, do you see any nascent red flags?
So I think that I was going to come back to one of the things that Bill just said about my own experience. So in 2008, we got caught in the Lehman debacle, and we had some exposure to Lehman Brothers. And what we hadn't quite understood is that Lehman had a London subsidiary, and the London subsidiary had a German bank, and all of them were regulated by different bankruptcy courts, and that despite having spent a lot of time thinking about the matter, you could actually have some credit exposure resulting from difference in jurisdiction. Now, the end story was a good one. We got our money back, and we learned from it, and we learned from that in such a way that we cut all exposure to MF Global in 2011. But I just look at myself in an introspective fashion and say, it's really helpful to have gone through crisis because you learn good habit about what not to do. And to answer your question right now, there is clearly a search for yield. And some of the area, I'm thinking, for example, of direct lending in the US, there seems to be a lot of money chasing few deals. And the opportunity may not be as attractive as what they have been 2 or 3 years ago. And so all of the people on this panel are all very careful about how to invest the money and make sure we don't get dragged by momentum and just get seduced by what are not very attractive returns. And I think that's the challenge and that's the skill.
Has it reached irresponsible levels?
No, it hasn't. But I think that it's incumbent to all of us to do a fiduciary duty and think critically about what we have in our portfolio and to think about the downside and think about what can go wrong. And I'm sure we all do. And taking into account what we know and what we don't.
So when we think about credit, we're thinking about what's the gross spread we get minus the expected loss for the risk-adjusted spread. And if you look at loans, it's been a terrific asset class over the last few cycles. And what loans the last few cycles has been, it's about 60% of the debt in a capital structure. And the recoveries have been about 70%, and the defaults have been 4%. Now, loans are about 80% this cycle, materially thicker. So as a result, the recoveries, when you get the higher defaults, and regardless of the cycle, industries in transition, whether it's retail, media, telecom, energy, there's going to be defaults. And those recoveries are going to be lower as a function of being much, that the denominator is much larger. In terms of another aspect of this cycle where we see some issues or what people have forgotten is covenants. They're pretty terrible. And so what a covenant is for an equity issuer, it basically creates an environment where heads I win and tails you lose. So what do I mean by that? Heads I win. It means if things go well, I'm going to refinance your debt at a cheaper level. Tails you lose. With poor covenants, it means I get to issue more debt either at your level or actually even senior to you and layer you. So we think that's a forgotten lesson of the last cycle.
Yeah, a lot of people are surprised.
I see Tom smiling here.
Tom, jump in.
No, I agree. I think you see, and that's sort of your classic in the credit markets. As you get later in the cycle, you see things like covenants give way. But you also see maybe the investing activities, certain managers get more aggressive in search for yield. So they're taking on riskier positions potentially or trying to lever up a little bit more at the end of the day. And so in some ways, we've lived through that before, in various cycles from 90 to 91 and 2000, 2002, and of course the GFC. But the other aspect I think is a little different here, and it plays into what Steve is saying. There's a lot of new industries. If you look at some of the companies and industries that we are leveraging, have not gone through that cycle. And we don't necessarily sometimes know what the recovery patterns will be.
Can you give me an example?
Certain types of technology, as an example, where you're levering up subscriber bases, and that may flow through in a normal recession, and may not. So it's not the old cash flow with hard assets behind you world that was a lot of leveraged finance 20, 30 years ago. You're leveraging up new industries.
We're just picking up on that, Tom. One industry that I think has really been impacted by leverage, and I'm on the disruption side, as you know, but if you look at traditional retail and how levered up it was over the last 10, 15 years, one, it created obviously some problems for those companies, but beyond that, their ability to react and invest in the challenge from online, the challenge from Amazon, was severely limited.
Right.
And you really wanted to be an attacker, because with that much leverage, there's just the degrees of freedom for these companies were severely limited.
And John, I remember you had mentioned that volatility that's fueled by leverage is another area of concern, speaking of leverage. Institutions, as you observed, are built for it, but maybe not everyone else.
Right. I mean, when you think about the a few months ago, there was the sell-off in the market in the inverse VIX floater retail funds.
The shorting volatility ETFs.
Yes, right. This little arcane retail mutual fund, which was levered, which theoretically you couldn't lose. I mean, most funds you can't lose more than 100% of your money, and some of these actually you could.
Yes, you can.
I mean, people had no idea what they were buying, and retail investors were out there trying to play volatility in the market. Most professional investors don't do that. Those products being available and being out there, and the fact that I think somebody had told me that 2 of them had been in the top 5 most traded things on one of the electronic consumer trading platforms, that's where you get trouble showing up. And I can't do something in a normal way to get the return I'm looking for, so now I'm going to buy something I barely understand, but lever it. Is the old adage that the restaurant is terrible, but it has huge portions. It is not a good idea.
Well, ETFs, weigh in on this, Manny. Are they worrisome product?
I think just to go over some of what has been said before, I think you need to match your asset and your liability. And so if an ETF is in something very liquid like the S&P 500, the QQQ, no problem. You can trade rapidly, you can trade at a good execution price. The moment the ETF is on some more illiquid asset which may suffer from market disruption, you have a problem. So Jonathan gave the example of a short vol strategy where not only did the ETF perform very badly, but also the mark-to-market on the exit was very poor. You can think of an ETF on a basket of illiquid bonds, where when one will want to go out, not only you will face the liquidity of being able to get out, but the price will most likely be not very good. And so I do think that making sure that you have a match between asset and liability is actually very important. And just to come back to the point, and we may be slightly more bearish than other people on this panel, but this is the time, as Dan and Tom and I think about the world, to stay on the fairway and make sure that you focus on simple things and make sure you try to add alpha in things you understand and try not to take the driver to go on the green.
Yeah, are these ETFs, Tom, that are where the underlying assets are bank loans or high yield? I mean, is this going to be the next mortgage-backed security or problematic product that leads to, if not a crisis, a downturn?
Well, I agree with Manny. There's definitely, when you have a mismatch between the liquidity of the underlying asset and the structure that's being traded, there is a risk that there's a diverging issue. The owner of the ETF can sell it that day, but the manager is sitting there trying to find liquidity. And so when you're managing in structures like open-ended structures with less liquid assets, you have to be disciplined in what you buy and your ability to provide that liquidity. In the mutual fund market, there's probably been more history of managing things like loans in an open-ended structure. So I think that is a mismatch. There's another element here. ETFs and a lot of other passive investments and indexing have come in for a reason. They're much lower fees. And in a low rate environment, that was very attractive at the end of the day. I think what you heard and hear about some of the back and forth on where the risks are, certainly passives have a place in someone's portfolio, whether it's institutional or individual. But when you start getting into credit, you start getting into emerging market equities or emerging market debt, active management still plays a big role because that judgment is necessary. You're picking value and you're avoiding risk. And I think the active passive debate is a fair one, but quite frankly, if you're late in the cycle, you should be leaning more towards active managers who know where the risks are coming.
What should your time frame be, though, as you look to active? Because it's not going to be something that you're going to be able to see returns on.
Well, I would argue this, where active managers in U.S. equities may be trending to the index, if you look at things like high-yield bonds or leverage loans or emerging market debt, I think you see more outperformance from the managers in general, even in an up market.
Scarlett, can the equity guy ask a question to the credit guys?
Please.
Around risk, which is global debt. One thing that I'm trying to get my head around is you look at the world and you've got 165 trillion, I think the number was, of global debt, public and private, and it's gone up tremendously. And as Steve said earlier, we're moving into a rising rate cycle starting here. It may flow through Europe and even Japan. And what I'm trying to think about is, how does the world deal with that level of debt across all sectors of the economy, public and private sector? And does that come home to roost at some point and ultimately impact economies and also, from my point of view, equity markets? But I thought that this group would probably have some insights into that.
Who wants to take that first?
Sure. It's I've never looked at it's almost like the U.S. deficit and looking at the absolute number. I've always tried to break it down to what is it relative to the economy, what's it private sector, public sector, how it's matched. So it's hard to kind of just starting with the question. It's hard to kind of react to such a large number without understanding the components. In terms of and where the components are, if Venezuela, gee, it seems like it has a lot of debt. Seems like it's not terribly functional. Kind of concerned about Venezuela, as a snapshot. Contrast that with the U.S. Not terribly concerned on the U.S. relative to other places. So I think there's also a relative conversation, and then there's also the rule of law. In different places have different jurisdictions, have different. I guess you have different rates. So if you're not government debt or quasi-government debt, it's just a different conversation. So that's some of the things in the mix. It's not a specific question, or not a specific answer, but those are some of the variables that I would try and break it down to.
And I would add, where I started actually, I think your question actually has a lot to do with the whole ball of wax is going to be the shape and how fast rates rise in the United States.
Yeah.
And there's a big rate differential right now between the U.S. and Europe, and the recovery and growth rate is different in Europe, and I think you may see continue to see a decoupling there. And rates can rise for good reasons. The economy is growing and things are doing well, or rates can rise for bad reasons, which is we're withdrawing quantitative easing and it's sort of gotten out of hand because nobody's ever done that before.
Right now it's for the first reason?
I think so, but I'm not completely certain. And I think we're very, very early in unwinding an experiment that's never been done before.
Yeah, exactly.
And I think that there's an enormous amount of talent and great minds in the financial world and in universities trying to study this and understand where it's going to go and where it could go. Right now, it seems like it's happening in a fairly workable and straight and smooth way. But that is, if you were to ask me what worries me about rates, is if somehow something happens and they spike and they get out of hand, and something goes wrong with a treasury auction, LIBOR spikes, that's where people are now dealing with rate increases in a way that don't match how fast earnings are rising. And that's where it could start to bleed over into Europe, I think.
But it is a strange world, in a world where Italy funds itself in 10-year at 1.7 and the U.S. fund itself at 3%.
Right.
And I think there's one reason. It's the ECB and the fact that the ECB has narrow the spread on Italy and Spain at levels which are long-term totally unsustainable. And the challenge will be how Mario will get out of it, and the most likely outcome is very slowly because the spreads are just too tight. But that bias markets, and I think when we buy asset in this country, we all have to think about the fact that the riskless rate is at the wrong price.
Right.
You also have the adjustment of currencies. So that's one variable that people aren't putting in the mix, which is that's another way for total return on compensation. Another variable is, for instance, you take in Latin America, they used to finance a lot of their debt in dollars. So how the U.S. rates work was very important. Now, how they're financing their debt significantly more is in the local debt, in the local currency. So that's more, I guess, internal. And so the issues of what happens in the U.S. don't necessarily come into play where it did in some other cycles.
Let's wrap things up here by having everyone give their number one idea, and it could be a theme, it could be a product, it could be a geography, or product, as I mentioned, for what investors should focus on to generate, let's call it reasonable returns, either in liquid or illiquid markets, and what they should avoid as well. And we'll just go across the board here. Tom, why don't you start?
Sure. Well, real quick, I think in illiquid markets, one of the great opportunities is really investing behind the technology trend. Real assets, private equity, growth companies. In particular, we have themes like logistics. Everything's changing. And that's going to create real estate opportunities. It's going to create other types of opportunities for investors. Broadly, we're probably a little more bullish on international markets, with the U.S. being fairly valued on the equity side. And as I said before, we think we're late mid-stage, so we're still constructive on credit. Last thing that worries me most is what we don't know. And the only way you can manage that is what you do know, manage it well.
Bill?
Asia in general, I think, is an important theme led by China and India. You're going to have the greatest expansion of the global middle class we've ever seen happen there. That will increase spending power for everything from financial services, healthcare, consumer products. And I think as investors, being leveraged against that trend is a terrific opportunity. Second would be this, back to what I said earlier, the transition to a digital economy. It's impacting every part of the global economy, every part of the world. And those, to me, are the two most exciting themes. I sort of telegraphed myself on the risk. I just worry about the level of debt that's floating around. And Jonathan said it, as the monetary experiment unwinds, is it going to be successful and a smooth ride, or is there going to be something unexpected that hits us?
And it's something we won't know until years after the fact.
Exactly.
Jonathan?
I think I'd say a couple of things. I'd say in the liquid space, in the liquid credit area, I'd keep it, as Manny said, keep it in the middle of the field. I think relative to the economy, you can just do a good job picking credits that don't default and earning income. And I think in our private markets, private equity, special situations, venture, life sciences, make sure you're investing in things where you're bringing something to the table to change the answer. You're not just playing the momentum of markets.
You're not passive.
You're not passive, that you do something to the investment and you bring something to the table that helps change the company, change the trajectory, and you add value to the investment. It's really more important now than ever.
I give you a long and a short in the PIMCO world. On the long side, we do like private real estate lending. You'll earn LIBOR plus 3 to 350 with good loan to value. And on the short side, I would say that if I didn't like Italy in Europe, I like even less the European high yield, which also trades below US Treasury, and that makes no sense whatsoever with, as Steve said, terrible confidence.
Yep, I agree with Manny that European high yield doesn't have a lot of value. And in general, we think there are going to be better points to get into high yield than what you have now. So just systemically, I think it's not terribly interesting. In terms of what is interesting, I think that Latin America in general has a lot of disconnect. Even looking at something like Argentina, you look at some of the local debt that's less than a year and you hedge it into dollars, you can pick up almost double, triple the yield in some cases. And it's really about capital control. That would be the obvious concern, which we just don't think is going to happen. So we think that there's a lot of opportunity in Latin America.
So Argentina is your trade that you'd recommend or the region that you recommend. What was the one that you wouldn't? A European high yield.
I think on European high yield, it's just uninteresting. I mean, and they actually, it seems like, ironically, they give you a premium if you're small. It's like go figure.
All right. I want to thank everyone on this panel, and thank you so much for joining us this morning. Steve Tananbaum of GoldenTree Asset Management, Emmanuel Roman of PIMCO, Jonathan Lavine of Bain Capital and Bain Capital Credit, Bill Ford of General Atlantic, and Tom Finke of Barings.
Thank you.
Have a great day, everyone.
Thank you.